I was asked for some help on how to determine the adjusting entry for when we're doing the cost method. And so I just wanted to pull up a couple of these problems and help you do that quickly. So we're not going to do the whole problem, but we will look at that adjusting entry. And so I have the book pulled up on the left, an Excel sheet over on the right. Let me zoom in a little bit. Okay. And so we have to keep in mind that what we're doing with this adjusting entry is really just updating the account to an as-if equity method. And so to do that, we are going to take the change, so I already put delta here, the change in the retained earnings of our subsidiary, and that's going to be since acquisition minus the sum of our AAP amortization. And so once we know that, it's pretty simple. I have a feeling that it's just a matter of figuring out if we're going to use the beginning retained earnings versus the ending retained earnings and the number of years that we're looking at where there might be some issues with calculating the number that we're looking for. So we have assumed a parent company acquired a subsidiary on January 1st, 2018 for $1.2 million. The purchase price of $650,000 is in excess of the subsidiary's $550,000 book value of stockholders' equity on the acquisition date. Of this excess purchase price, $250,000 was assigned to property, plant, and equipment with a remaining economic useful life of 10 years. $400,000 was assigned to goodwill. On the acquisition date, the subsidiary reported retained earnings equal to $280,000. The parent uses the cost method, and the financial statement for December 31st, 2019 follows. And so we have that here. So we'll start plugging this in. First, we're going to look for the change in retained earnings of the subsidiary. And let me see if I can just copy this really quickly so I don't have to insert the symbol again. And so when we're doing that, we're always going to use the beginning retained earnings for our subsidiary. So that's going to be equal to our $600,000 minus $280,000. So here I'll put 600 minus 280. And then I'm going to put a note. Remember to use the beginning of year RE for our subsidiary. Then we have to get the change in our AAP amortization, or the sum, not change. And so let's see here. For AAP amortization, we have the $250,000 by 10 years. So $25,000 per year. And so now we can calculate this and say equals to our change in retained earnings minus the sum of the amortization. And in this case, it's only the second year, so we only need to multiply that by 1. Obviously it's going to be the same number. I'm going to still do that in the formula to help identify that we're saying 1 year has passed. And so we get $295 as our adjusting entry to bring this to an as-if equity method. So that's for the numbers that we're looking at with this 43. Let's go to 45. Oh, I think I went too far. So for 45, we'll do the same thing. We're going to try to figure this out, but we're looking at 4th year. So assume the parent company acquired a subsidiary on January 1st, 2016 for $1.5 million. The purchase price was $900 in excess of the subsidiary's $600 book value. The excess price includes $400 of PPE with remaining life of 16 years, $300 of a patent with 6 years, $200 was assigned to goodwill. on the acquisition date, the subsidiary reported retained earnings equal to 360. They use the cost method, and then it's going to give us their financial statement. So let's jump over there. We'll do our change in retained earnings first. So I'm going to just copy this down. So beginning retained earnings was 700. So we'll say, I'm going to go back. I think it was 360, but yeah. So we'll say equals 700 minus the retained earnings from the date of acquisition of 360. And we have 340. Get some commas in these numbers. All right, and then our amortization. So let's do it for each item separately. So first we'll do the PPE, and we'll just do it per year. And so it was 416 years. So we'll say 400,000 divided by 16, so 25,000 per year. Then we have to get the patent per year, and that was 300,000 divided by 6 years. And so if we do a sum here, we get 75,000 per year. And let's put a line here just so that we know that we're looking at a subtotal. Okay, so now we can plug this into our formula, and so we're going to say equals the change in retained earnings minus, and then the 75 times 3 years, because we're on to the 4th year, so we need to bring it to current. It would be times the 3 years prior to this, so times 3, and we get 115,000 as our adjusting entry to bring this from cost method to an as if equity method. I hope that helps.